Right. So it's 4. We have 1 hour straight in front of us. So let's start. I hope by the time, before you begin, we should have most of the attenders joined us already. So let me quickly begin, right? So we've got some people who've joined us. So welcome to you. And we hope you're all excited for this webinar today. I'm going to say good morning, good afternoon, and good evening, because I know you're joining us from everywhere around the world. So hello to you all, and pleasure to have you with us for this discussion today on private equity and mergers and acquisitions in Africa, where we're coming to see a continental outlook. And we will be listening and interacting to our expert today, who I will be introducing shortly. Today, I will be your host. So I am Dikshita, currently the founding president of the Women in Finance and Investment Network, which is basically a global network of women professionals, male affiliates, institutional partners, education providers, and so on. So welcome again to this webinar. Right. So today we have with us our he for she, a private equity and mergers and acquisitions expert, Mr. Jean-Philippe Sayed, the managing director at Development Partners International, who has joined us as the facilitator for this discussion. Now, before I give you an introduction of our facilitator, a brief on his profile, let me just give you a breakdown of today's session. So we will keep it strictly to 1 hour because Jean-Philippe has to run for some other meetings, right? So in 1 hour, we'll have our presentations, and in the end, we will end with a Q&A session. So please bear this in mind. As he does his presentation, if you've got questions, there's something you'd like to ask him related to this discussion of today, please use the Q&A box that you see in front of you, sorry, and just send the question there, and we will take it when we close from the presentation. Right, ladies and gentlemen, please join me in welcoming Jean-Philippe Sayed, as I said, the managing director of DPI. From now on, I'm going to refer to him as JP. I hope that's okay.
Absolutely, absolutely.
Great. JP is the principal at DPI, an African-focused emerging market private equity fund with $1.8 billion asset under management, which he joined in 2016. He looks after 10 portfolio companies in the sector, such as banking, higher education, pharmaceuticals, healthcare, agribusiness, packaging, fintech, and facilities management. He is a board member of the HPM Hospital in Marrakesh and was also involved in founding Calyx Bio, a $750 million specialty generates emerging market pharmaceutical buy and build platform focused on oncology and critical care drugs. His prior work experience combines investment banking at BNP Paribas and JP Morgan with management consulting at McKinsey & Company and the Boston Consulting Group. He has extensive experience leading M&A, strategy, and transformational projects for government entities, major corporations, and financial sponsors across both developed markets and emerging markets. JP speaks 5 languages and has graduated from Imperial College London with a master's in aeronautical engineering. JP is a citizen of France, Canada, and Bangladesh, and has worked and lived in 5 continents and visited over 125 countries. Wow. All right, now this one is like what, 65% of the world that you've seen, JP?
Yes.
Hey!
I've seen mostly the airports and the hotels, you know, when I was working. But
wow, so anybody here who is also like, you know, a fan of traveling and all, Along with advice on private equity and mergers, you can even seek advice on traveling from JP. We've got that expert here as well. Right, JP, warm welcome to you. And thank you so much for letting us host you on WIFIN's platform.
Super. Thank you very much, Dixita. Thank you. It's really an honor and a pleasure to be here. And I hope you'll enjoy the presentation. We leave about 10, 15 minutes at the end for you to ask questions. So please don't hesitate to do that. And also, you can also send questions in the chat, I guess, during the presentation. Happy to take those on live. So don't hesitate. Cool. So let me
share your screen.
Share my screen.
Good.
Is that good? You can see this?
Yes, all good.
Super, fantastic. So, all right. So I split the agenda in two parts today. The first part is to talk about the African private equity landscape overall across the continent, and then to talk about effective private equity strategies in Africa, which are mostly anchored around M&A. So overall, this is looking at all emerging markets. So 2021 has been a very good year for investments across emerging markets. And this has been particularly driven by venture capital, which now makes more than half the investments in emerging markets. So you can see, the dark piece of VC has become really huge. It's doubled over a year. And now we have fully recovered after COVID in terms of investments. So this is the really great news. If we look at the share of private capital investments for Africa, you can see a huge jump. In 2020, maybe 10% of investments were venture capital. In 2021, we're looking just under 50%. So it's really become a driving asset class for the continent. In fact, if you look here, the share of private equity, infrastructure, and credit has remained more or less the same, the total amounts from year to year. It's really the venture capital that has exploded. So this is for emerging markets overall, and now we focus on African private equity in particular. So if you see here, in 2021 there was 6.3 billion invested in Africa across 454 deals. So clearly the stagnation of COVID has been overcome, and we're back at a record level of investment and a record level of deals. And here again, VC represented nearly half of this. Fundraising also has returned to pre-COVID levels. Overall, private equity fund managers raised 3.1 billion for Africa. And this was led by DPI, so the fund I work for. We raised 900 million for ADP3. So this really helped reach this figure of 3.1. But there was also a huge fundraising for credits for 91's second Pan-Africa fund of over 700 million. So very large fund for credit funds. And importantly, exits also increased 44% year on year. So last year, it was very hard to exit private equity. There was just over $1 billion of exits. And, for private equity fund, it's very important to exit because that's what allows you to then raise a new fund. You can't raise a new fund until you've exited the old fund or partly exited the old fund. So this is very good news with this exit increase. However, even though we've increased considerably or nearly doubled compared to 2020, in 2019, the exits were 11 billion. So, we're still far in terms of exits. So what that means is that multinational companies are still a bit scared to come and invest in Africa. The investment activity has returned overall, but multinationals are not yet coming back, after COVID. I guess they're being a little bit more careful, but hopefully this is going to change soon. In terms of VC, as I mentioned earlier, it's been a real bumper year for VC overall. And we've got to 308 deals for VC in 2021 compared to 170 the previous year. So it's really doubled in amount of deals, and the capital invested has grown 10 times. So basically, this means that the size of the deals has gone up significantly over this period of time. Okay. Sorry, I'm just looking in the chat if there's any questions. Yeah. So VC activity in Africa in 2021 has actually now surpassed the levels that Southeast Asia and Latin America had in 2017. So Africa is really catching up very fast in the VC section. And there's a lot of indicators that this growth is going to continue. There's also now many local managers in VC, because before it was mainly the Silicon Valley and other US VC investors that were coming to Africa, but now there's a lot of local VC funds that are ramping up. And you see this huge value that you can see, the 308, the 3 billion invested in VC. Half of this was done by 22 deals. So this means that there's already many tech unicorns in Africa. You know, we've seen Jumia, we've seen Flutterwave, we've seen Wave, Andela. So this really bodes well and shows that Africa can, you know, spawn unicorns like any other continent, and it's actually very encouraging. Over half the capital went to fintechs, and then some B2B play in like logistics and agtech. Egypt, Nigeria, and South Africa together accounted for 2/3 of the deals. So those were really core. The Senegal had one big one, but the Francophone countries are a little bit behind in terms of the VC potential in Africa. Then next, in terms of, the sectors invested. So it's traditional finance and fintechs are really the sectors that got the most investments. Payments is made more than half, with, you know, very successful companies like Wave and Flutterwave, InterSwitch, etc. But also lending. Lending is also big with 33%. Another, so within infrastructure, we've seen also a change to digital and tech-enabled types of investments. So digital infrastructure went up from 500 to 671 million in 2021. And previously in 2018-19, there was no digital infrastructure investments. So it's become very, very hot. Transportation has gone down, and renewable energy is stagnating a little bit, and digital infrastructure has really become exciting. And we've seen 7 big deals. So we saw Adenia, IAM, and IFC do a towers deal for 130 million, East Castle Infrastructure. Helios and others also did a towers deal in Africell, 100 million. And then there was the WIOC, the undersea cable, connects bringing internet under the sea to Africa, which was a very large deal. And then some fiber and data centers are also becoming very hot. There was Onyx Accra in Ghana, but there was also Main One in Nigeria. So all the enabling the digital infrastructure, which is, you know, also fueling all the VC investments, is also fueling investments in the infrastructure space. Renewables, as I mentioned earlier, has kind of plateaued. I think there was a lot of money poured into renewables. In fact, there's over nearly 6 billion available to invest into renewables, but of which 500 are from Africa-based funds. But the level of deals is quite flat. You see here, it's from 400 to 670. There's a lot of money out there chasing, you know, solar power, wind power, etc. But there's not enough deals in Africa to invest in. So this is a bit of an issue in the renewable space. You know, a lot of excitement, a lot of people put money in, but unfortunately, there's just not enough opportunities to put that money in. So that's a bit of a shame, and hopefully this will change going forward. Now, in terms of private equity investors across the continent, there's actually more than 600 active investors in Africa today. So really a huge number. However, if you look at the big ones, then there's maybe around 30 here that over $1 billion in AUM. But there's really a multitude of people focused on Africa, and some of them are global funds that also invest in Africa, but a lot of them are pure Africa focused funds. So you have a little bit of everything. And I'll show you an overview of the biggest players. So you have obviously DPI, that is based in London, one of the largest Africa-focused private equity funds. So we are Pan-Africa. We invest all over the continent. Even though we're all based in London, it's just we find there's a better access to the whole continent from there. And it allows us to build a strong culture by all being in the same place and exchanging ideas, etc. You have Helios, our arch nemesis, also very big and successful funds. I'm joking. We actually work very closely with them on many deals, but yeah, they're also very large and successful funds. They also have 3 funds, and they're also based in London, but they do have office in Nigeria, and they're also Pan-African. So so Helios and ourselves typically look at tickets at over, from 50 to 150 million dollars to invest. Actis also looks at big tickets, but they are now really focused on the energy front. They do have some education, but sorry, they are really the masters of the energy sector. You have AIM, who also does quite big tickets, but they are only focused on infrastructure, so it's very particular. Then you have what I would call the mid-level, mid-sized tickets players like Africa Invest, one of the oldest private equity funds focused on Africa. They initially started out of Tunisia, but now they really focus on the entire continent. And they've already had 5 or 6 funds, and the latest fund is around 500 million compared to ours, it's $1 billion. So they're looking at tickets that are slightly smaller, say from 10 to 50 million. But it's a very attractive and exciting company. And SPE Capital also was started in Tunisia, funnily enough, and they've also raised quite a large last fund in the 250 to 300 range. And now, originally they were only focused on North Africa, but now they're also looking at all the continents, and they've opened offices in Egypt, in Morocco, and are very active at the moment. You have also ACA Capital. Now these guys are focused in Nigeria. Their office is in Nigeria, but they look at all of West Africa, including Francophone, and they're also looking at that 10 to 50 million dollar tickets, and they're very active. Ametis, they are based out of Paris. They were founded by 2 ex-Proparco executives. They have many offices all across the continent. They have offices in Nairobi, in Abidjan, in Paris, and they're also doing the 10 to 50 million dollar ticket range. They're also very innovative. They created a new fund that looks also to the Middle East, and they've also starting a fund for European, French, but also European companies that want to invest in Africa. So kind of going the other way around. So they're being quite innovative in their product approach. Then you have other, like the people that Métier, Carlyle, which are big international funds that also look at Africa. TPG is another one there. However, Carlyle now, this team has rebranded to Altera. They've left the Carlyle group and rebranded to Altera. And then what else do you have? Leapfrog is also similar to Carlyle in the sense that it's a global fund, so they invest all over the world, but they only do financial services and healthcare. They can also do large tickets, especially since they recently signed a deal with Temasek, which is giving them a lot more firepower, up to 500 million. But again, here's only financial services and healthcare. Old Mutual, Investec, these guys are and Métier are the South African guys. They really started the activity, and Ethos also, sorry, out of South Africa, and have slowly expanded north to look at all of sub-Saharan Africa. but the core investments really are played out of South Africa. Now, there's been a lot of change since I had first made this slide. So Carlyle has become Altera. Ethos has bought Braid and merged it. What else? ECP has split in two, and part of it has gone to Altera, part of it has gone into an infrastructure fund. So, while there are lots of funds, 600, over 600, as I showed you previously, unfortunately, not all are doing that well. And I will now go to the next section and show you why. Or maybe before well, basically, the reason is today, unfortunately, despite Africa having a tremendous growth and a tremendous potential with the fastest growing GDP, the fastest urbanization rates, a very young population, the performance of African private equity has not been great compared to other countries. If you see here, emerging Asia, developed Asia, even Europe developed, Europe emerging, Middle East, all of these geographies perform much better than African PE. So this is over 10 years. Over 5 years, things look a little bit better, but still, Africa really, PE really lags performance of the rest of the world. And this, unfortunately, makes it very hard for African PE funds to raise capital because, other regions, private equity funds do much better, including emerging countries. So investors say, why would I put the money in Africa? I'd rather put it in these other countries or other regions. And also because the stock markets have been performing so well in the last couple of years, investors think, I just put my money in the stock market. Why should I take a risk and invest in African private equity? So it's really, in the last couple of years, it's been really the DFIs that have been pushing and helping African private equity because they want to attract capital to be deployed in African companies to help African companies develop. And they've been really, really key to keeping the industry afloat. And so I will now go into the section to explain how you can perform strongly in African private equity. But maybe I'll stop a second to address some of the questions here. So the first question was, do you think AML CFT is effective in the global business? So, anti-money laundering, KYC compliance is really key in African private equity. It's very difficult because often companies don't have the right type of documentation, the track record, etc. There's a lot of corruption across the continent. Business practices are not always as transparent and clear as they should be, and the governments are not always super supportive in creating easy frameworks and environments for companies to invest in certain countries. There's a lot of restrictions around foreign currencies. You can't take money out of Ethiopia, you can't take money out of Nigeria, same of Morocco. There's restrictions on exchange rates, so it is very difficult. Nevertheless, AML is important and vital, especially when you have a lot of DFIs investors, which all the private equity funds do. And so we invest a lot in our compliance teams, and are very collaborative and find effective ways of working with the companies. There's, however difficult it is, you cannot take any shortcuts in money laundering, bribery, and KYC and compliance as a serious investor. So we put a lot of effort into here. And to give you an idea, we are at DPI we're about 40 people, and 20 are front office and 20 are support functions and compliance. So, which is a very different ratio than you would see in other funds where they have smaller compliance teams. We actually have to put a lot of resources in this to be successful in Africa. Another question that's come here is, why do PE funds in other geographies perform better than in Africa? So this is a very good question. So I would say one of the key reasons is that in other geographies, private equity funds use a lot of leverage. They come in, buy a company, take a lot of debt, and then use that company to pay the debt back. And then, once they've paid all the debt, they exit and have the company for free, right? In Africa, it's very difficult because the banks are not used to this kind of risky transaction of leverage buyouts. And also in Africa, there's so many different currencies. You know, it's very risky to take large amounts of debt in local currencies or in hard currencies and then have a currency mismatch. So typically, African private equity funds have much less leverage than international funds, and that really affects the performance. Other reasons the P funds perform better in other geographies is also the sophistication. Those funds have been around for 40, 50 years, and they've been very sophisticated in the way they manage the funds. So they have special clauses which allow them to, when they get money back from investments, to be able to reinvest them, and so use that money 2 times in this life cycle of the fund. They can take special facilities. They have hybrid capital structures, and so they've managed to create a lot of tools to boost performance in other ways. So African private equity funds are catching up and learning and trying to replicate that. But because we have a lot of DFI investors like CDC, Proparco, IFC, these type of investors, while they're very supportive and help private equity a lot, they're a little bit more risk averse, so they don't necessarily always let the African private equity funds do some of these techniques and tools that private capital funds use in other countries. So that's another reason, I would say. And then finally, I would say another reason is that it's very expensive to do deals in Africa. While other funds in other geographies, they have one lawyer in-house that can do all the deals. In Africa, you have 54 countries, 54 different jurisdictions. Everything is different. You can't just rely on people say you really have to do very thorough and deep due diligence, going through the accounts in minute detail, and this is very expensive. So that's also another reason that happens. And then also on the performance side, the different jurisdictions is also a challenge for the portfolio companies. So, a typical fund in the US or UK, they'll have 12 different companies, and then, they'll be able to do common sourcing. So they'll buy all their IT equipment together. They'll buy, they'll share some resources like HR, etc. across. But in Africa, because of all the different jurisdictions, you can't really do things like that because, again, there's too many restrictions country to country. So that's also a bit of a hindrance to performance. And so also this.
Jean-Philippe?
Yeah.
Yeah, I'll just cut you here. Now that we've spoken about the countries, country-wise, I just have a question, like for myself, right? So, right, we've heard a little bit of South Africa, we've heard a little bit of Nigeria, but what other countries or sectors, that seem to be more of a particular interest for foreign firms in terms of private equity investment?
Sure. Until last week, I would have said Egypt was super attractive destination. Obviously, now they've devaluated the currency, but actually, I'm joking because it will make it even more attractive now because of the devalued currency. The companies will perform better. But Egypt has had tremendous growth, a lot of money going in, 100 million people, and great growth, and relatively easy country to invest in, to take money in and out of. So that's made it very, very attractive. Another region but the currency was the main thing holding people back because everybody was expecting the currency to devaluate, and so they were waiting a bit. And now that it has devaluated, I think there will be a big push to go into Egypt again. Another region that's really, really attractive is the Western Africa, the Francophone West Africa. If you look at countries like Senegal, Burkina, Cote d'Ivoire, you're looking at 7, 8, 9% GDP growth. They have a currency that is pegged to the euro. So for foreign investors, there's less currency risk. There's a lot of international banks there, and it's very exciting. On the downside, the population is not huge. If you take away Nigeria, of the other countries, but the growth is so tremendous, it kind of overcomes that. And the other thing is also there's a lot of reliance on commodities, especially cocoa, rubber for Côte d'Ivoire, that can affect things a little bit. So yeah, but it's a very, very attractive and exciting area. Unfortunately, one of the challenges there, at least for us, is that there's not many big companies to invest in. So we're looking at 50 million, 250 million tickets, and unfortunately, sometimes we are too big to invest there. We don't see enough deals at our size. But people like Africa Invest, SPE, they're doing very, very well in that region, and it's very exciting. But hopefully we'll be able to do more there. And so those are really the key exciting regions or countries for me. Nigeria also is exciting, but being such a large population, but it's not easy to invest there. There's a lot of risk, so that's why I haven't included it in my top two. Super. Look, maybe I'll take cryptocurrency. I think
let's take the questions at the end. Let's continue with the presentation.
Yeah, exactly. Let's go. Okay, let me close this. So as I explained, private equity returns for Africa are not very high, right? And this is why some of the players have been struggling. However, it is possible to do very well in African private equity, and DPI in particular is one of the best performers on the continent. And if we compare ourselves to emerging Europe, LATAM, in Africa, we're in the top quartile compared to all these regions. And compared to US, developed Europe funds, even emerging Asia, like China and places that are growing tremendously, would be still in the second quartile. So really still in the top half of the performance. So it is possible to do well in African private equity. And I'm going to share a little bit of our secrets on how to do so. So there's several strategies that you can apply to outperform, in private equity. So the first one here is what I call champion selection. In Africa, there are some particular industries that are benefiting from the emerging middle class. And these industries in Africa outperform the same industries across the rest of the world. So if you invest in these specific industries, you're more likely to do very well, and to do very well even when there's a recession or there's any issues, because the underlying growth trends are very strong. And I'll then, after I go through this slide, I'll show you some examples here. And in particular, within these industries, there are some champions that outperform these industries. So if you're able to identify these outliers and invest in them, that will generate a very, very strong performance. So this champion selection is really one of the core strategies. The other strategies are all focused on M&A. So it's buy and build, which is essentially buying several companies across the continent and aggregating them into one single company. This is also a very successful strategy. Now, there's two ways to play this strategy. So the first one is what I call accretive M&A. You have some important pricing disparities across the countries. So if you capture these disparities, you can really create a lot of value easily. So for example, if you look at countries like Morocco, Egypt, the valuations are very high in these countries. You're looking at 12 times, 10 times, 12 times, for example, 10 to 12 in the industry sectors, like 14 to 16 in the pharma sectors. So you have very, very high valuations. Now, if you look at other regions like Kenya or East Africa or Francophone West Africa, or even South Africa right now, the valuations are very low. You're looking at maybe 6 to 8 times for a pharma company. You look at industry company, 8 to 10 for a pharma. So basically, if you buy a company in North Africa, and then you go and acquire other companies there. Then when you create the platform, you're going to value the platform at the original multiple. So you're acquiring something at 5 times, but then you're revaluing it at 10 times as the platform itself. So this allows you to create a lot of value very easily just by capturing the multiple arbitrage between the different countries. Similarly to that, another buy and build strategy is what I call the synergistic platform. So this is creating value from a combination of cost synergies like raw materials, shared services, but also revenue synergies like cross-selling. And because of the size of a platform, by buying, you can also hire superior talent that each individual company would not be able to afford. But by creating a larger platform, you can then hire, global experts, global champions to come and run the company. So here, this works particularly well when there's a strong price elasticity on raw materials. So, for example, if you have 2 companies buying, I don't know, let's say the raw material is paper, for example, to make cardboard. So you have a large company that is acquiring cardboard at $500 a ton, whereas smaller companies across Africa might be acquiring it at $1,000, $1,500 a ton. So double or triple the price. So if you then acquire these smaller companies from the big one, you can then buy the paper at 500 or even 450 because now you've become bigger, so you have more negotiating power. And then you introduce that raw material at that price in the smaller countries, which allows you to be extremely competitive, and basically you can cut prices and dominate the market. So this is also a very powerful strategy for private equity in Africa. Another one is import substitution. So this is what I call vertical integration. So this is the buy and build in blue, and in green you have vertical integration. So vertical integration is buying a company and then transforming it. So for example, a company that makes cardboard and is importing paper from another country, well, then you build another factory to make the paper yourself, for example. So you're integrating vertically along the value chain. And to build these factories, you can get government or DFI credit and subsidies and other facilitations that allow you to have this for a very good price. So basically, although it's hard to get leverage for an acquisition, it's much easier to get leverage, to get credit to build a new factory. So by doing this, you're actually getting the gearing, getting the leverage that global market private equity funds have in Africa. So this is also a very powerful strategy. Another strategy in vertical integration that's very effective is going from distribution to production. Now, distributors typically cost much less than industries, right? So, for example, a pharma distribution company will sell for 5 to 7 times the EBITDA. However, a pharmaceutical company producing that will sell for, say, 10 to 12 times EBITDA, so double the cost. So basically, if you buy a pharma distribution company that has access to all the pharmacies, they're importing and selling the drugs to everybody, but then you start building your own factory to produce your own drugs. And because everybody already knows you, because you're selling into all the factories, into all the pharmacies, you can easily then sell your own products. And that as the part of production becomes more and more big, and once you're over half your income is coming from the production, then suddenly, the company that you bought for 5 to 7 times EBITDA is now worth 10 to 12 times EBITDA. So that's another strategy where you can create a lot of value by transforming a company. Here I'm just giving some pluses or minuses of the different strategies. The champion selection. Another advantage of the champion selection is once you find this kind of champion, it can actually become an anchor for your buy and build strategy or your vertical integration strategy. So once you have this strong company, you can do many other things with it. The problem with the champion selection is they're very expensive, and often they don't want your money. They're making so much money and they're so successful. They don't want equity investments. They'll get some credit, they'll get some debt, but they don't want equity. So it's a problem for private equity funds. In terms of buy and builds, accretive M&A, this is very good for North African markets where the valuations are very high. And you can use leverage on the balance sheet to buy the other companies. However, it's not applicable to all industries. For example, financial services, it's very, very complicated to do this. And you can also generate FX exposure if you start, investing in different countries from the same. The synergistic platform, well, this works very well where there's unified regional markets like UMOA, EAC, COMESA. So these, boring things that the governments do actually help a lot for this kind of strategy. However, it's also subject to regulatory and tariff barriers. It requires a very strong team in the center to go and capture all the synergies. So it's difficult to implement, but it's obviously very rewarding when you do that. In terms of the vertical integration, there's raw materials plays that I explained earlier. And what's great is that not only you increase your valuation, but you also increase your margin. So you're actually winning on two fronts. So this is very, very attractive. But it's also very technical and operational challenge because you are unifying the industry, you're unifying your factories. Often you need large capex expenditure to build a new factory to go into the raw materials. So this is also very technically challenging. And distribution to production, well, this drives big multiple expansion, as I explained earlier, and it's well adapted to industries which have import bias. So industries where there's a lot of importation of raw materials, but it's also a technically operating challenge. And it can also alienate your suppliers and customers. If you're importing drugs to sell them to the pharmacies, and then suddenly you're producing your own, well, the guys will be like, yeah, I'm not gonna sell you my products anymore because you're competing with your own, and I'm sure you're pushing yours harder than mine, right? So they're not always very happy with the people that adopt this strategy. So as I promised, this is the chart that shows the industries in Africa compared to the rest of the world. So basically all the industries above this line are growing much faster in Africa than in the rest of the world. So healthcare in particular is one that does really well, wholesale and retail and services. As you see, banking insurance is more or less on the line, so there's no particular advantage, but food, healthcare, retail, light manufacturing, telco to some extent, these are all industries that do much, much better in Africa than elsewhere. So it makes them very exciting. And the common thread between all these industries is that they all benefit from the emerging African middle class. And you can throw COVID at it, you can throw a war in Russia, you can throw everything. The African middle class will not stop expanding, they won't stop urbanizing, they won't stop using more and more tech, and so this is really, really a strong trend. So these industries are particularly attractive. Now, as I was explaining to you, within these industries, you can find real champions. So here I've put on the bar chart, the growth in Africa and the growth globally in different industries. Oh, sorry, I inverted the legend. The green is Africa, the blue is the rest of the world. But you see, we found in each of these industries players that are actually performing much higher than the industry average. So not only are in industries that are doing really well, that are very strong in Africa, you can find amazing champions that really outperform the industry strongly. And these are really the guys you have to look for. So in terms of buy and build, so I'll give you one example. So with Université Privée de Marrakech, we bought this university in Marrakech and made it the KMR education platform. So here the idea is to acquire assets between 4 to 8 times EBITDA and build a platform that's valued at 12 to 14 times. So when we bought this university, it had 3,000 students in Marrakesh. It had saturated the local market. It had 80% of students were going to this university, especially for business and engineering. So there was not much opportunity for further growth. So what we did the buy and build platform. We bought Université Internationale de Casablanca. We bought Choub de Kooi Marrakesh. We bought a hospital in Marrakesh so that we could launch a medicine faculty. And we bought a medicine school in Senegal. And this allowed us to have 450% growth in students, increase the campuses by 7 times, add 5 new faculties. So from business and engineering, we added hospitality, healthcare, medicine, dentistry, etc., and give us an annual growth of 30%. So this, but the real value creator here was, we bought all of these universities for either at cost for the hospital or at 4 to 8 times EBITDA. And the overall platform is valued at more than 12 times. So really a huge value creation there by building a platform. General Emballage. Now, General Emballage was the leader of cardboard in Algeria, producing over 200,000 tons a year. And the price of the imported raw materials increased by 50% over 2 years. So originally we were buying paper at 50 dinars per kilo. It went up to 75. In reality, today it's gone up to 100. So it's actually more than doubled. And so they were buying over $100 million worth of paper every year. So what we did is spend 300 million to build a paper factory, creating 4,000 jobs by doing this. And just this factory with the paper prices today will generate 80 to 100 million EBITDA and save 30 to 40% of costs. And in order to build together 300 million, we managed to get debt, for over 200 million. So only putting 100 million in, we're getting something, that's generating 100 million of EBITDA 8 times. So that valued at 800 million. And, once we pay back the debt, we only spent 100 million to build this. So, that's making 8 times return on this. So fantastic type of return. So building, going upstream and starting to build a factory to produce your own raw materials can be something also very, very exciting in private equity. Biopharm. So this is a pharmaceutical business. So this is the example I told you before around the distribution to production. So this company, when we bought it, was mainly importing and distributing pharmaceutical drugs. Only 9% of EBITDA was from manufacturing, and the manufacturing was very low added value. They were just making drugs, but not for their own name, for other players. However, they were the leader in distribution, so they had access to all the wholesaler and to 5,000 factories across the country. So what we did is we upgraded the manufacturing infrastructure, created an 8,000 square meter manufacturing plant with the European high quality machinery from Germany. And we built a really state-of-the-art also oncology plant for cancer drugs, and really trained the staff. We actually used McKinsey for this project, and really strengthened and launched the own brand. And thanks to this, there was a 444% contribution to EBITDA increase from the manufacturing business, 156% increase in EBITDA margin, and we increased the number of trained staff by 230%. So real big efforts. And here, we're going to make more than 6 times our money on this investment thanks to this. So very, very high returns. And then another example I have is Dolly Doll. Dolly Doll is the leader in mattresses and foam products in Morocco. They had 40% market share. So, but the Moroccan GDP and population growth got flattened out. So Dolly Doll had few opportunities for further growth in Morocco. And plus, since we wanted to do an IPO, we need to diversify the revenue base and capture further opportunities in the region. So, oh, sorry. Oh, sorry, apologies.
Sharing.
Yeah, the screen sharing.
You have to share it again.
Yeah, no worries. No worries. Here we go. Okay, here we go. So we then, from Dolly Doll, expanded into Côte d'Ivoire, Senegal, Nigeria with the acquisition of Muka, and are looking at targets in Eastern Africa too. Now, because the key raw material to make mattresses and foam is called TDI, it's a petrol derivative. And basically, the more you buy, the cheaper the price. And so by acquiring or building these other facilities across Africa, suddenly we were able to improve our margins by 420 basis points because we were getting the raw materials for 420 basis points less, basically. Sorry, we're reducing our COGS, so our cost of goods, by 4.5%. So huge margin improvements. And by bringing these cheap raw materials into all these countries, we were able to, for example, in Côte d'Ivoire, in 3 years, we gained 40% market share because we are suddenly bringing mattresses much cheaper than all the competitors. And this is because we had this huge market in Morocco, so we're buying such huge quantities of raw materials. And we're replicating now the same in Nigeria and the same in the other countries that we're going. So we were able to increase sales by 73% and increase the production by 76%, and with a huge margin improvement. And this margin improvement is where we're really creating all the value. So this is all I had for today. So thank you very much for your patience and listening to me. And I will now see what other questions we have here.
So, let's stop the share option.
Oh, sorry. Shall I take off the screen share, you're saying? Okay.
Yeah, yeah.
Okay, sorry. Yeah.
Sure. So let's take the questions. Let me just say this. We have like 10 minutes before we end the session. So if you've got questions, please drop them on the Q&A. And as we go with it, we'll take them. So we've taken the first question already, and we were to discuss the cryptocurrency. So GP, do you think cryptocurrency is taking over the investment platform compared to the usual listed or private equities?
Look, I don't see that today. Where I see crypto working well is, people, individuals investing in cryptocurrency and putting the savings there, and hopefully making some good returns. It's something I feel is very difficult to predict, and you can't analytical tools like looking at the growth of a company or looking at the outlook of an industry like you would do on the stock market. But some people have figured it out and they'll invest their own money and do that now, for sure. But in terms of buying companies of hundreds of millions or tens of millions and stimulating an industry, there's nothing like VC or private equity. Crypto today doesn't have that range, that scale, and big institutional investors like ourselves are not yet using it as a currency. So, and some countries have banned it. So I don't see it. I definitely see it as a taking over. Personal investments, like from stocks. Now people might prefer to invest in crypto, but it's not going to take over from PE and VC to development, contributing to development of a continent, and by doing deals for tens of millions of dollars.
Okay, we've got a question related to Mauritius. So how far is Mauritius interesting international funds mentioned for private equity?
Oh, Mauritius is an extremely attractive destination. So we used to have all our funds based in Guernsey or Isle of Man, one of the kind of UK Channel Islands jurisdictions. But for our latest funds, we actually have a dual structure where we have the Guernsey and Mauritius. And this, I see it as a big trend. A lot of the South African companies are all opening Mauritian holdings. It's a great place to do business and to administer your funds because it has the advantage of being in Africa. So as an Africa fund, rather than being in the Channel Islands, it's better to be in Africa because some of our investors can only invest in Africa. So we need to have an African structure to invest. So I think it's by far the most attractive destination in Africa to invest from. So, you have very highly skilled people. that speak many languages, French, English. So it's very helpful for that. The legislation is also very favorable. So it's very easy to open a fund or open something in Mauritius. And also it's very cheap from a tax perspective. The tax rules are very beneficial. So yeah, overall Mauritius is very well advanced, and it's already become the destination of choice in Africa for this purpose.
All right, thank you, JP. I hope this helps towards this question. We've got a question from Ikria asking what accounts for the poor performance for Africa, private equity and venture capital. Yeah.
Yeah, look, I think we addressed this performance early on, this question earlier on slightly. For me, the key factors there is the difficulty of using debt as a tool to boost your returns in Africa because of the currency differences, and just the banks are not used to doing sophisticated acquisition debts as banks are in the rest of the world. And this is particularly, it's less true in Morocco and South Africa, but very true across the rest of the continent. The other factor is African private equity funds not being as sophisticated in using advanced tools to boost your returns, such as recycling funds, such as using bridge debts to not call management fees so often and boost that. And also because a lot of the investors in African private equity are development institutions that are very risk averse and impose a lot of conditions to the funds that don't allow them to do some of the riskier stuff that can boost your returns. So I think it's a combination of all those factors basically.
All right, JP, quickly, how would you describe the regulatory framework in Africa, right, as they apply to private equity?
Well, the whole issue is that there's not one regulatory framework. There's 54 regulatory frameworks, and that's precisely what makes it very difficult. Is that you need experts in every country, every geography and it makes it very expensive to do private equity. So that's one complexity. And then some countries in Africa have restrictions that you don't see anywhere else in the world, right? Like not being able to take money out, or not be able to freely exchange the currency, requirements for local owners to own at least 51% of certain companies in certain sectors. All of these things make it very hard. And at the same time, also the legal framework is not strong, so that if somebody tries to, if there's some fraud or some issues with the company, it's very hard to go after the people in Africa. So all of these things don't make it hard for investors such as ourselves, and also for the people who invest in our funds. There's a lot of mistrust, etc. So yeah, it's regulatory framework is definitely challenging. But once you learn how to navigate it, then you can do really well. But it's a lot of hard work.
Yeah. All right. Let's take 3 last questions, and then we close. There is a question here, very interesting expose on strategies adopted. So is a project like the Silk Road that China conceptualized and realized, is that possible in Africa to ease and increase trade? And if it's a yes, how do you realize it, taking into consideration all types of barriers?
Yeah, look, it would be fantastic to do that, right? And it's starting. There's a road that's been built from Algeria all the way down to Benin. Also, before, all the countries were not connected from the fiber and internet to each other. Now there's big undersea cables connecting the whole continent. And but the currency and the regulations are really what makes it tough. The transport is being addressed, I think, fast. The transport issues from country to country, but yeah, the regulation and currencies are the bigger challenges of today.
Okay. I hope that helps. We've got another question. When you hire someone, do you have some specific requirements? What are the indispensable knowledge, experience to have? Right.
they need to know how to sing and dance and no, just joking. Look, we try to hire the best of the best, and we try to have a good proportion of women. In fact, our CEO is a woman, and we are the global leaders of or the flagship fund for the 2X initiative for the promotion of women in investment jobs. So we really try to keep an equal ratio of 50-50. All our interview panels, we always have half men, half women, so you don't get a bias in the selection of candidates. So we really promote hiring women throughout, and we have women. We have what, 3, 4. Apart from the CEO, we have 3 more women partners. 40% of our partners are women. So that's very important for us. And so we have a very equal and unbiased selection process. And in the candidates, we look for excellence and in whatever they do. So be it investments, being it in helping our companies grow, being in fundraising. So that's very key. But the second thing we look for is also passion for Africa. So people who really are focused on the continent, and they just don't want to join DPI for a year and then go and work for international funds. People who really want to have a career in Africa.
Perfect. Bertrand, I hope that helps, and shout out to DPI for promoting diversity, equity, and inclusion. Hello?
Yeah. Oh, I think, Dikshita, we're losing you a little bit.
Hello?
Yes.
I
have to leave, sadly.
Yes.
But I really enjoyed all the tricky questions, and it's been a really fun discussing African private equity with you. So thank you very much.
All right, thank you so much, JP, and thank you to the participants as well. Unfortunately, JP has to leave. He's a busy man. So we'll see you probably next time. JP, have a good...
Absolutely. Thank you very much. Bye-bye. Thanks for joining.